听见资本本期视频为您带来的是贝莱德4月15日的开门会，主题为美国关税暂停90天，投资者现在应该如何应对？美国政府宣布暂停对90国的互惠关税90天，却将中国商品关税推高到 145%。这个看似矛盾的决定瞬间撕裂全球市场，标普500指数上演冰火两重天，创下二战以来第3大单日涨幅。同时，美国30年期国债收益率创下1987年以来的最大周涨幅，美元汇率跌破3年新低。国际资本正从美国市场集体出逃，这场关税地震背后隐藏着更危险的信号，粘性通胀、财政赤字与供应链脱钩正在重塑世界经济规则。贝莱德分析师揭开了市场剧烈震荡的真相，传统60比40股债配置策略已经失效，国债不再是投资组合的避风港。当黄金成为新宠，另类投资策略崛起，全球顶尖机构正在秘密调整布局，从欧洲股市的估值洼地到制药半导体行业的关税风暴眼，每一处波动都暗藏机遇与杀机。更令人不安的是，这场暂停可能只是序幕。未来90天，美国政府将重新谈判90项贸易协定，新一轮行业关税已在路上。财报季此刻成为生死线，企业利润率将暴露在关税利刃之下。数据显示，专注优质资产与强现金流企业的策略今年逆势上涨，而盲目追涨杀跌的投资者已亏损 8%。 当 VIX 恐慌指数飙升至疫情以来最高点，你是否准备好应对这场颠覆性的财富洗牌？市场正在惩罚每一个心存侥幸的人。分散化投资不再是一句空话，而是生死存亡的关键。从黄金配置比例到另类对冲策略，从欧洲估值修复到行业护城河筛选，顶级机构的3重防御体系已然成型。这场由华盛顿政策实验室引发的金融海啸正在改写每个投资者的财富命运。接下来是英文会议的全部内容。如果您需要我的投研助理人工加 AI 辅助校对的中文文本，您可以在频道的 Patreon 上获取。
On April 9th, the U.S. administration announced a 90-day pause on country-specific reciprocal tariffs, exempting key tech imports while maintaining high tariffs on select Chinese goods. Global markets experienced extraordinary volatility in response to this tariff pause. The S&P 500 rebounded nearly 6% last week and had one of its largest daily jumps in history. Meanwhile, long-term U.S. Treasury yields spiked, and the U.S. dollar tumbled to 3-year lows against major currencies. But the question remains, how should investors respond when considering the implications of prolonged uncertainty, including potential recession risks, impacts on corporate investment, and consumer spending?
Well, the first question we're getting is, should they stay invested? But then the next question is, okay, well, if I'm staying invested, what do I need to do? And that's when this diversified point comes out.
This is not the end. It's probably not even the beginning of the end. It may be the end of the beginning of all of this, and there's going to be more volatility to come.
Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Polito. Coming up on The Bid, we continue our market coverage following tariff policies and their impact on the global markets. We're recording and publishing this episode on April 15th. To help us navigate the recent market moves, I'm joined by Alex Brazier, Global Head of Investment and Portfolio Solutions at BlackRock, and Helen Jewell, Chief Investment Officer for EMEA at BlackRock. Alex and Helen will help us unpack the details of this tariff pause, its effects on market dynamics, and provide strategic insights for investors considering how to navigate volatile markets. Helen and Alex, thank you so much for joining us on The Bid.
It's great to be here.
Fantastic to be back, Oscar.
Helen, welcome back. I know we had you on recently to talk about infrastructure. And Alex, it's been a while. It's really good to have you back. We have some sort of pattern where we seem to invite you when there are really complex things going on in the markets, and we need someone to help explain it to us, and that seems to be you. So, Alex, let's start with you. The last week has seen a lot of volatility in the markets. I should mention we're recording this on Tuesday, April 15th, just to give a sense of what point in time we're in. But maybe you can give us an overview of what has happened in the last week with respect to tariffs.
What has happened in the last week? One day, whole books are going to be written about what happened last week. So let me just try and summarize very briefly. There are 3 broad buckets of things that were, I think, historic about last week. The first is in fixed income markets. We saw long-term interest rates in US Treasuries have their biggest sell-offs for decades. The 30-year US Treasury yield had its biggest weekly rise since 1987. And both it and the 10-year US Treasury yield were up about 50 basis points in a week. Now, they've stabilized a bit since, but that market remains pretty volatile. Now, to some extent, the fundamentals had been in place to drive long-term interest rates higher for a while. We've got sticky wage growth, signs of labor shortages, sticky inflation. And most importantly, in the United States, we've got a fiscal position, deficits and debt levels, that's historically very large, and a lot of issuance coming up for the market to digest. So the fundamentals were in place for yields to rise. But then we also saw some mechanics of the Treasury market amplifying the move. Our trading teams here at BlackRock have been monitoring what's going on, and they think there was some pressured selling from hedge funds that had effectively bet on US Treasury yields falling relative to the equivalent interest rate swaps and futures. Now, it was all pretty orderly. It wasn't like we saw at the outset of COVID, but all of that combined for a move in fixed income markets of pretty historic proportions. So that was the first thing. Second thing that was really notable in the last week is that even as interest rates rose, the US dollar weakened. And that was suggestive of international investors moving money from US assets to elsewhere in the world. And we saw in exchange-traded products particular flows from the US into Europe. So that was the second striking thing about last week. The third striking thing about last week was, of course, that on the back of all those moves in markets, perhaps prompted by those moves in markets, we saw a big change in the policy of the US administration. We saw a pause announced on what are called reciprocal tariffs on 90 countries for another 90 days. So that leaves us with a baseline 10% tariff on imports into the United States, plus extra tariffs on autos and steel. And at the same time, we saw tariffs on Chinese imports into the US, raised to 145% after a sort of tit-for-tat escalation between Washington and Beijing. That leaves us at a level of tariffs that many analysts think is inconsistent with doing much bilateral trade, actually, between those countries. And it's north of where the president talked about on the campaign trail. Now, we saw at the end of last week an exemption announced for electronics products, given the disruption that tariffs at those levels might have caused to important supply chains, which just goes to show, actually, that this decoupling process is going to be really hard given the way supply chains are wired. But then we saw, to top it all off, an announcement that we could expect new sectoral tariffs on pharmaceuticals and semiconductors to come. So big moves in fixed income, interesting move in the dollar and capital internationally, and a big change in policy. But this is not the end. It's probably not even the beginning of the end. It may be the end of the beginning of all of this, and there's going to be more volatility to come.
Alex, you mentioned there will be whole books written about this past week. I think you've given us the first few chapters. You talked about the fixed income markets, what's happened in currency markets, and then highlighted the evolution in tariff policy. But Helen, one thing we haven't talked about yet is the equity markets. How have they reacted to all this news?
Well, of course, the equity markets have had a really rough few weeks. If we look at the implications post-Liberation Day, there was a two-day fall of just over 10% in the markets, making it one of the worst two-day drops since the S&P was first created. You know, up there you've got the 1987 crash, you've got the peak of the financial crisis, and of course the 2020 pandemic. But what's also really important is that post this pause announcement, you then saw the S&P post the third biggest one-day gain since World War II. So that pause was incredibly important in terms of the market moves as well. And in some ways, that's been what's the most challenging for investors, because that has introduced real whipsaw risk into the market. You've seen significant moves very quickly, both on the downside and then on the upside. And the VIX has reached the highest level that we have seen since the COVID pandemic at around 50. And this uncertainty in the markets and the uncertainty of how long the uncertainty lasts is something which is of concern for investors. Now, what's been weird is that the last couple of days, so as you say, today is Tuesday, Friday and Monday, although there have been a few announcements in terms of tariffs, actually in terms of the market reactions, we've seen a few swings, but nothing to the kind of level that we had seen. So it feels at the moment that although the market is moving a little bit, it's certainly pausing just to see exactly what comes through in the next 90 days. So it's going to be an incredibly important 90 days for markets. And as Alex says, it probably is the end of the beginning. And I'm looking forward to the middle segment when we can actually start to understand what is going to happen in the tariffs, and we can start modeling out what those implications will be for corporates.
You mentioned the whipsaw risk. Last week we spoke to Glenn Purvis in the BlackRock Investment Institute and also Gargi Palchodri, and we sort of talked about the need to stay invested in these markets because markets can move pretty quickly. And in fact, the day after we spoke to them, Helen, as you noted, markets bounced back. And so illustrating the challenge for equity investors now of what to do. And our message was stay invested because volatility is moving in both directions. Alex, perhaps to come back to you, we talked about equity markets, but you also mentioned at the very beginning of your comments the importance of the move in the bond markets and the fact that interest rates moved higher. I think historically, when we see periods of market volatility, we've been accustomed to seeing the U.S. Treasury market rally in those periods. In other words, interest rates going down. So what is the significance of interest rates going up? Does that mean that U.S. government bonds are no longer the ballast in portfolios that they used to be?
I think it means they're not as reliable a ballast in portfolios that they used to be. Old school portfolio construction was really about a broad index of stocks and a broad index of bonds, and you could pretty much rely on the fact that when one went down, the other went up. So when stock prices fell, maybe in a recession, you knew that interest rates were going to fall and bond prices would rise. So there was this neat negative correlation between them. They were a nice natural hedge for each other. And that's no longer reliably the case, as we've seen recently. We're in a more inflationary world. We're in a world with bigger fiscal deficits and higher debt levels. So long-term bonds just not providing that ballast, as you put it, that they used to. So investors are thinking about, well, how do I build a portfolio to stabilize things in some other way now? And there are various ways to do this. We've seen lots of flows into gold, for example, as an alternative diversifier, and that's done pretty well over the last year in performing that role. But there are other ways too, and one way historically, and that we've seen investors taking more interest in recently, is to effectively take down your exposure to the broad index of stocks and the broad index of bonds, and instead replace it with strategies that make relative calls within those markets. So they might take a long exposure to one part of the stock market and a short exposure to another. So where the broad market goes isn't really relevant. It won't have much of a correlation with that. The return will be determined by whether that relative call pays off. Now, if you do that in this sort of environment, you can actually build portfolios that are more stable but still generate return. And what you're trying to do is just reduce the correlation of your portfolio with those broad stock indexes and broad bond indexes. But overall, it's an example of how when bonds don't work as a reliable ballast like they used to, actually it requires some pretty hard thinking about how to build portfolios and how to diversify them.
And that's a theme that we've been discussing actually for quite some time with our guests, which is we're in a new market regime, and that new market regime requires investors to be more active, more granular, and perhaps more diversified in their portfolios than they historically have. Helen, what questions are you getting from investors, and how are you thinking about positioning a portfolio during times like these?
Well, the first question we're getting is, should they stay invested? The answer is absolutely yes. You should stay invested because of the whipsaw risk. But then the next question is, okay, well, if I'm staying invested, what do I need to do? And that's when this diversified point comes out. You shouldn't at this point in time be significantly over or underweight anything, whether that is from a sector perspective or indeed a geographic perspective. Make sure portfolios are sensibly diversified, both in terms of the balance between equities and bonds and also other asset classes, alternatives and gold, as Alex mentioned as well. So diversified portfolios remain key. we're also maintaining a more defensive stand overall. This isn't the time to be looking down for beaten down turnaround or recovery kind of names. This is the time to be thinking about where is their quality, where is their strength in the balance sheets, and where is their robustness and resilience in cash flows, earnings, and margins. And the other thing that we're very much keeping an eye on is valuations and valuation levels. What we've seen at the moment is a lot of the stocks that are moving significantly are those where the valuations have been at the higher end of the scale, where they've seen significant run-ups. You're seeing a bit of an anti-momentum move in a lot of pockets of the market at the moment. So valuations remain incredibly important, and Europe is an area that from a valuation perspective looks interesting. So where valuations are compelling are really interesting places to look again, both in terms of a geographic perspective, but also in terms of a sector and a stock-specific perspective as well. If you've got conviction on names that have seen a significant pullback, maybe it's the time to be leaning into those names. But staying invested, being diversified, and keeping an eye on valuations, they're the key things that we're telling investors right now.
Helen, you talked earlier about that there's uncertainty, and specifically there's uncertainty about how long that uncertainty will last. So what are you keeping your eye on right now to feel confident that, in fact, we've put that period of uncertainty behind us?
I think the period of uncertainty is going to keep going for a little bit longer. We've had a lot of conversations about peak uncertainty. I'm not entirely sure what that means. And I feel the peak uncertainty was probably the day of the announcement of the tariffs. And everything from now on in perhaps is less unexpected and more baked into numbers. But in terms of what we're looking at, I always focus on the things that I think I can understand. And we're just starting to go through the earnings season. It kicked off last week in the US and it started this week in Europe as well. Now, I had been a little bit dismissive of this earnings season. I looked back and I thought, well, the Q1 numbers are just historic numbers, and it's just going to be too soon for corporates to give any kind of sensible guidance of what they might do. We're just going to have an air pocket. But I realized I was wrong. The earnings season is going to be incredibly important both in terms of the narrative, but also understanding which companies are really able to build on the margins that had already been quite high last year. We were seeing high margin levels through 2024, and maybe therefore are going to have more of a buffer to absorb things like tariffs that might come through. So this earnings season is going to be incredibly important for us to really assess which companies are well-placed, high quality, have those moats that are therefore going to enable them to navigate this period of uncertainty, which I'm sorry to say, I think is going to be with us for a little bit longer.
And Alex, what are you looking out for in the near future?
Well, I'd start by answering that with something we've learned from investors. We've been surveying investors quite a lot through this period, and they've been pretty consistent in staying invested. 60% of respondents typically say, I'm not doing anything with my portfolio. So they're listening to Helen in some respects. 20% say, I'm looking to defend a bit more, looking to take down some risk. And 20% say, actually, I'm looking for opportunities here. In some ways, I think they're all right. So definitely stay invested, but we're looking for new opportunities that emerge. There are going to be opportunities after a period of volatility like this to go a bit more on the offense. People are going to need to be agile in their allocations, and they have been. We've seen record trading volumes in exchange traded products over recent weeks, suggesting a lot of money is actually in motion. But as Helen describes, this is probably not an environment where just leaning into the broad index is necessarily the best approach. The dispersion that's here, the importance of quality names and resilience can't, I think, be underemphasized. So careful selection and looking for opportunities. So that's the first thing. Second thing we're looking for is protection in the portfolio against downside. Equity volatility has come down, but it's still high. And as Helen says, uncertainty is going to be here for some time to come. The administration is going to be trying to negotiate 90 trade deals in the next 90 days. We've got more sectoral tariffs coming. So we're looking for ways, like 20% of investors, to defend in the portfolio as well. And for example, indexes of stocks that are designed around stocks that typically aren't very volatile through the economic cycle, they've done very well year to date. They're up year to date when the broader S&P index, for example, is down 8%. So we're looking for ways to manage that volatility. And then thirdly, as I said before, we're looking for ways to diversify portfolios in diversified ways. We're looking for alternative strategies now that we can no longer fully rely on bonds in the same way we used to, which is something that's actually playing out in the money that's in motion. We're seeing money sometimes move out of higher risk fixed income and equities, but not in the traditional way into long-term bonds. We're seeing it move into shorter-term bonds and inflation-protected bonds. So investors are really getting their hands around this need to diversify the diversifiers in the portfolio.
Interesting. When you talked about the results of the survey, when you talk about the investors that you've been speaking to, the answers varied a lot, but I love what you said, which is they're all right. In other words, stay invested, and it's more about what you're doing within your portfolio in these times that matters most. Helen and Alex, I'm not sure if both of you are naturally authors, if you plan on writing a book about this period that we've been through, but I know audiobooks are a thing, so I think you've given us a start at what's been going on, and perhaps we'll have you back on at some point so that you can tell us more about the subsequent chapters. We appreciate you giving us this color, and we appreciate you doing it here on The Bid.
Thanks for having us.
Great to be here.
Thanks for listening to this episode of The Bid. If you've enjoyed this episode, and if you want to keep up with what's happening in the economy and the latest market trends, make sure to subscribe to The Bid wherever you get your podcasts.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.